Hey guys, welcome back to Intro to Investing. In this video, we're going to cover three popular types of investments you can make: stocks, bonds, and mutual funds. So let's start off with the one most of you have probably heard of: stocks. So what is a stock really? Well, when you buy a stock, you're actually buying a very small percentage of the company whose stock you're buying. Now, even though you technically own some part of the company, it's such a small amount that you really aren't involved with any day-to-day operations. Stocks are publicly sold on markets, and two examples of which are the New York Stock Exchange and the Nasdaq market. These markets, though they both sell stock, have their differences, which is something we can discuss at a later time. Now, something really interesting about stocks is that they tend to rise in the long run. If you take a company, look at its stock from, say, 5 years ago, it's probably doing much better now. However, as you may know, stocks are much more volatile in the short run. Another thing which we'll discuss more in the next lesson is that stocks are heavily influenced by societal events. Take the current year 2020 as an example. The COVID-19 pandemic has sent some stocks into all-time lows, and this contributes to the next idea, which is that stocks are high risk but also allow for high reward. Moving on to a somewhat lesser known investment option, we have bonds. Bonds are essentially loans issued to a company or government by an investor. The three components of any bond are its principal amount, which is how much you loan to the company or government; maturity, which is how long before you are paid back your principal amount; and interest rate, which is the percent of your principal the government or company pays you every year. Bonds are often used to fund new projects, especially those that deal with creating infrastructure for any city or state or government. So now let's look at an example of how bonds are used. Let's say the city of Dallas issues bonds of $500 with 10-year maturity and 5-year interest to fund a new public park. Every year for 10 years, the city of Dallas will pay investors $25, and at the end of the 10 years, Dallas will pay back the principal amount, which is $500 in this case. Now, an especially great thing about bonds is how little risk they pose compared to other investment options. When you invest in bonds, you're banking on the stability of the government or company, and most governments are considered stable. Now, with that low risk also comes a relatively low reward. If you invest money in bonds, you have a very high chance of making money, though you won't be making a lot of money. Finally, let's move on to the final investment option, which is mutual funds. Mutual funds are collections of stocks picked by investing professionals. A lot of people like to think of mutual funds as a basket of sorts in which you have a large variety of different stocks. The primary benefit of mutual funds is that it creates a lot of diversification in your portfolio without you having to spend a lot of money buying different stocks in different industries. However, since mutual funds are managed by industry professionals, you have to pay a fee to the person managing your mutual fund. This fee can add up over time and can cost you quite a bit in the long run. Since mutual funds are so diverse, however, you have less risk than stocks, but still more risk than bonds, with the reward factor that's also in between the two. Now, before we end the video, there's one more thing I'd like to talk about, and that's ETFs, or exchange traded funds. ETFs are a type of mutual fund. Though there are a few differences between the two, the primary difference is that ETFs can be sold at any time during market hours, as opposed to mutual funds, where prices are usually set once a day. Now that concludes today's video, and I'll see you guys next time where we will talk more about the stock market.